One way to keep your deal out of trouble is to run it through our Fleming Deal Score index. Now, we've been a part of around 40 acquisitions. About half of those we did ourselves with a partner. About the other half are just deals that we advised on. And this is the criteria that we use to look beyond just the numbers to evaluate a business. So we recently looked at a software development company, and let's run that through the deal score and see how it scores. So our first criteria is buyer fit. We only look at deals that are a good fit for our partners. So for this one, our partner scored a 5 out of 5. He had 15 years of leading software development teams. But just to make this more interesting for most people, let's consider the average person trying to buy this. And I think the average person would be about a 3 out of 5. So they don't have any direct software industry experience, they don't have adjacent industry experience, but they have some good general business knowledge. Next, we're going to look at the organizational structure. We have a lot of people, but no general manager, no great team leader structure. Most of the employees have very short tenures of less than 2 years. So for this one, we're scoring it a 3 out of 5. Our next criteria is seasonality. Most small businesses have seasonality. This one does not. 5 out of 5. Next, let's look at customer concentration. Now, that was a big area of weakness for this business. They only had 3 customers. So that's going to score a 1 out of 5. That's about as bad as it gets for a customer concentration. We've seen worse, but not much worse. Next, looking at EBITDA margins. Now, these margins were pretty good. We're going to give it a 4 out of 5 here. It's in the high teens. Next, we're looking at longevity. We're a few years old, so we're out of that startup phase, but not very well established. So it's a 2 out of 5 on longevity. So despite some of these major negatives, they were asking a really high price for this. So we get a 2 out of 5 on the multiple. This one should sell relatively cheap because it's new, it doesn't have great organizational structure, and it's that major customer concentration. So the price is going to really need to come down on this one, but their asking price lands them at a 2 out of 5. Next, looking at cyclicality, we get a 3 out of 5 here. Companies are going to be choiceful about spending on new software. If time's tough and they're looking for cuts, this is one area that they might look to pull back on. They're not going to launch new products. So 3 out of 5. Now, in the cash conversion cycle, they do have cash coming in. They collect fairly quickly on their projects. So we're going to get a 4 out of 5. You have a slightly negative cash conversion cycle, meaning money's coming in before it needs to go out. So totaling all this up, we get a 33 out of 55 possible points, which is below our 39 threshold that we're really looking for a good target. So we didn't end up buying this business, and it's only really a good fit for someone with very direct industry experience. So when we put in our actual partner we were looking at this for, it would hit that 39 right on the line, the bare minimum for passable. Now, the valuation still would need to come down for us to actually buy this business, but it's right on the line. See how more businesses score? Give us a follow. Check out our profile. If you want to run the deal that you're working on, check the link in our bio and give the Fleming Deal Index a try. You can do it for free.